Hudson's Bay is gone. A company founded in 1670, older than Canada itself. Over 100 stores across the country are closing. More than 8,300 people are out of work, and the brand once valued in the billions was just sold off for $30 million. That's less than a downtown condo in Toronto. But this collapse didn't happen overnight. The warning signs were there, in the financials, in the shifting retail landscape, and in the company's failure to evolve. So, what happened? Today, we'll break it all down. Hudson's Bay started as a fur trading monopoly and eventually transformed into a dominant force in retail. In the early 2000s, Hudson's Bay operated under the HBC umbrella, owning major brands. At its peak, Hudson's Bay had over $7 billion in annual sales and real estate holdings across Canada valued over $2.5 billion. Its downtown Toronto location was once called the crown jewel of Canadian shopping, attracting over 40,000 visitors daily. The brand had heritage, it had prestige, and yet its financial told a different story. Let's look at some dates and numbers together. While revenue stayed in the billions, profitability was razor thin. Between 2015 and 2019, Hudson's Bay's net margin averaged just 1.9%. That means for every $100 in sale, they barely kept $2. Operating costs kept climbing, labor, lease, utilities, while competitors like Amazon, Walmart, and even niche brands were running leaner and smarter. From 2017 to 2020, sales fell by 18%. Debt rose to nearly $1 billion. In other words, Hudson's Bay wasn't just losing money, it was structurally broken. COVID was the final blow. When COVID hit in 2020, it accelerated every problem the Bay had. Foot traffic died, shopping shifted online almost overnight, and Hudson's Bay wasn't ready. Their online infrastructure, which they've invested less than $75 million in over 5 years, couldn't handle the surge. Compare that to Walmart Canada's $1.2 billion e-commerce investment, or Shopify's agile marketplace tools. By mid-2020, in-store revenue dropped by 55%. E-commerce sales accounted for just 15% of revenue, and supply chain delays left stores both overstocked and understocked at the same time. They missed out on the retail boom that lifted other brands and started burning cash fast. Let's get deep into debt margins and management. The financial collapse deepened in 2022 and 2023. Same-store sales dropped 9.8%. Gross margins shrank from 38% to 30%. Inventory turnover fell below 3 times per year. It used to be 5 times per year in the early 2010s. And lease liabilities grew to $420 million, a crushing weight as stores became unprofitable. Meanwhile, their online spin-off, thebay.com, posted a net operating loss of $118 million. Despite rising digital traffic, we have a clue about why that happened. Poor fulfillment, slow delivery times, and weak mobile UX. Their management was also questionable. Insiders say senior executives received bonuses while thousands of staff faced layoff with zero severance. It created a toxic brand image at exactly the wrong time. Here's the brutal truth. The economics of retail changed, and Hudson's Bay was built for a different era. Today's retail winners embrace omni-channel, the online plus offline synergy. They operate with thin inventory plus rapid fulfillment. And on top of that, they know their customers through data and personalization. Hudson's Bay clung to big, expensive stores, while direct-to-consumer brands like Aritzia, Lululemon, and even IKEA scaled profitably by cutting out middlemen and optimizing customer journeys. On another note, 60% of Gen Zs now say they shop more based on brand values and social media presence than legacy names. Hudson's Bay never connected with that audience. Just $30 million and a brand in pieces. So what did they do? In early 2024, Hudson's Bay was stripped down and sold off. Canadian Tire acquired the brand's rights for $30 million. A steal. It means that Canadian Tire has the rights to use Hudson's Bay's name, logo, and other brand assets for just $30 million, which is extremely cheap, considering the brand's long history, recognition, and previous market value. 28 stores were transferred to a new holding group led by a Toronto retail entrepreneur, which might be restored at some point. Real estate assets were split from the operating company years ago, a move some experts say protected the wealthy while employees were left hanging. Creditors expect to recover less than 35 cents on the dollar. Vendors are left unpaid, and over 80 million worth of loyalty points were voided overnight, a PR disaster and loss of consumer trust. Could have Hudson's Bay been saved? Yes. We have the answers, but only if bold decisions had been made sooner. First, digital reinvention. With $150 million to $200 million in e-commerce investment by 2018, they could have modernized their online store and built a resilient fulfillment network. Second was exiting underperforming stores. A controlled downsizing, closing 50 to 60 locations, renegotiating leases could have cut $120 million to $150 million in annual costs. Third, brand revitalization. Collaborations with younger designers, influencers, and new private label products could have made the Bay feel relevant again. Even the slight use of social media would have changed the outcome significantly. Fourth, and the last thing, was tech plus data. Investing in AI for demand forecasting and personalized marketing could have boosted margins by 3 to 5%, enough to tip into profitability. But those choices required risk, and Hudson's Bay chose tradition over transformation. In the end, Hudson's Bay didn't just fail as a company, it failed as a vision of what a retail could be in Canada. This wasn't just a business collapse, this was the fall of a cultural institution, one that employed generations, dressed Canadians for weddings, interviews, holidays, and quietly faded while the world moved on. As e-commerce giants and data-first retailers take over, the fall of Hudson's Bay reminds us no brand is too old, too big, or too historic to fail. What do you think Hudson's Bay should have done differently? Drop your thoughts in the comments, and if you want more business breakdowns, subscribe to Analyst HQ, hit that bell, and stay smart.